Hi, everybody. Welcome back to my channel where we always try to decode everything as easily as we can. And today we'll discuss about assets and liabilities of a bank. So, what are assets and what are liabilities? First, let's try to understand the term assets and liabilities. So, assets are something that we own and we can earn through using them. Now, for example, I have 100 rupees and I have deposited that 100 rupees with a bank. That 100 rupees for me is my asset because I can claim that amount from the bank and use it to buy whatever, use it to do whatever I want to with that amount, right? I don't have to return it back to the bank or I don't have to pay an interest for using that money. So that is a asset for me. What will be a liability? A liability will be when I have borrowed that 100 rupees from the bank and I have to return it back to the bank after a period of time with a particular interest. So that is a liability for me. Today we'll try to understand what are assets and liabilities of a bank, not for us as an individual, but banks. For banks, what will be the assets and liabilities? Now, if you see here, these are the classification of assets and liabilities, but we will not go into the just to see the theoretical aspect, but we'll practically try to go and look into the balance sheet of SBI and see how assets and liabilities are divided. But before that, I would like to bring your attention to two important parts here. One is your loans and advances, and the other is deposits. So, the loans and advances for a banks are the loans and advances the banks gives out to its borrowers, right? So, as a customer, we go and take loans from the banks. Now, these loans are something that the bank has used this money to give it to the customers. The bank is going to get that money back with interest from the customer. So, they are basically earning by investing in loans, by lending out as loans. So, that will be their assets. Why assets? Because they are earning out of those loans, right? It is not something that is going to be repaid by the banks, whereas it is something wherein the banks are going to earn interest. Now, deposits are the amount that depositors deposit with the bank, and they can claim that amount from the bank at any time they want to. So when there's a claim on that amount, it becomes a liability for the bank because the bank will have to pay that amount to the customers whenever the customer asks for it with an interest rate. So they are basically, there's an obligation to repay with a expense. There's an expense associated with it. However, in assets, in advances, there's a earnings associated with it. So when there's an earnings associated, it's an asset. When there's an expense associated, it's a liability. Now let's do one thing. We'll go and have a look at the balance sheet of State Bank of India. Okay. So let's go to the balance sheet and see. Now, capital liabilities are considered as one and are put under one particular heading, as you can see here. So capital is basically the shareholders' money that they have invested, and there is a return on capital that is going to be there, right? So you have to return, you have to give a return on this capital. So there's a claim on this amount, hence this will come under the liability section along with the other liabilities. So we add it with liabilities, the capital also comes into play. Now if you look at the schedules here, these schedules are basically the breakup of each and every line item that you can see. So if you go down for capital, you will see that this is the total 892, and this is the breakup. How this amount has come, they have shown the breakup, and see the capital has to be, there's a return that is associated with it. So they are going to have to return this capital with a particular amount, right? So this is a liability. Reserves and surpluses is another point that is there. So reserves are basically earmarked, or these are basically for the purpose of future expansion or loan losses or any regulatory requirements. So basically the bank is preparing for potential challenges or opportunities by keeping these reserves and surpluses at a side. So this is the accumulated undistributed profit, which will basically signify the bank's ability to generate wealth for its owners, right? So whenever the dividends are paid, those are paid out of reserves and surpluses. So this amount again has to be kept aside, and it is basically a, it is a claim that the shareholders can make on, right? The shareholders can decide on how to use these funds. So hence this is again a liability. Then minority interest again is a big topic, but here we can just understand that this is basically the non-controlling interest. So here we are looking at a consolidated balance sheet. So this includes your subsidiaries, not just State Bank of India, but the subsidiaries of SBI as well. So minority interest is that portion of the subsidiaries net assets which basically are attributable to the shareholders other than the bank's shareholders. So other than the bank, the other minority shareholders have a claim on this particular amount. Okay, so this is like a claim on the consolidated entities resources by the third party. So the consolidated entities, whatever resources are there, the claims by the third party, the minority shareholders in the minority interest. So this again is a claim. Then deposits, I told you in the beginning, deposits are again the deposits of the depositors which have to be returned as and when required. Now, if you go to schedule number 3, you will see the breakup of deposits. See, there are demand deposits, saving bank deposits, term deposits. Now, these are the amounts that the bank has to return to the depositors, be it banks or be it other retail depositors, corporate depositors. They have to return this amount back with an interest. And hence, since this amount again has a claim and has to be returned by the bank with an interest, there's an expense associated, this will be in the liabilities side. Then borrowings. If you go to borrowings, these are all the borrowings that the bank has made to raise funds. So this is a way of sourcing the funds for the banks, which the banks are going to use later, and it has to return this amount back to where it has taken the borrowings from. So if it has taken banks borrowings from RBI, it has to return it back. From other banks, it has to give it back. Other institutions, bonds and debentures, they have to basically return the borrowing amount along with the interest rates to the respective lenders, whoever has lent this amount to the bank. Other liabilities and provisions, so whatever has remained, whatever other liabilities has remained above up after considering all these points will come under other liabilities and provisions. For assets, we have cash and balances with RBI. So whatever balance and cash, so as I said in the beginning, I had 100 rupees, that was my cash and balance. Similarly, banks also have their cash and balances which they have kept with RBI, on which they again earn interest. So this is going to be an asset because they're earning out of it. Okay, it's a source of income, not a source of funding or expense, but a source of income for them. Balances with banks and money and call short notice. So call and short notice, what is call money and notice money? This is basically lending to other banks who have a shortage of money for a short period of time, that is 1 to 14 days. Whatever amount that SBI has lent to other banks, be it HDFC, PNB, whoever bank had a shortage of funds for a short span of time for a period of 1 to 14 days, the SBI had lent this amount to these banks and they are going to get it back with an interest after the period of time, tenure. Then whatever investments, let's go to number 8. So they must have made investment in government securities, in shares, see, in debentures and bonds. So all these securities, in all these assets, they have invested, and these investments are going to give them returns and interest amount. Hence, they are earning out of the investments made, and this is going to come under assets. Advances, I told you, because loans and advances are given out by the banks to whoever wants to come and take money. So the bank becomes the lender and bank earns interest on the money that they have given to the borrowers. Okay, so that is again an asset for the bank. Why asset? Because after a point of time, whatever money they have invested is going to come back to them with an interest. Okay, with a income associated with it. So fixed assets and other assets. Fixed assets and other assets will include the premises of a bank, the buildings that they have. Okay, so that is owned by the bank. These assets are owned by the bank. They can sell it whenever there's a need. They can use it in whatever way they want to. That is their asset. So that is their own property. Hence, it will come under assets. So this is the balance sheet, and these are the various components that you can see under a balance sheet. And this is what I wanted to discuss with you when it comes to understanding how the balance sheet is going to be. So I hope you've understood how the assets and liabilities are incorporated in a bank's balance sheet. What are the components? And I've also shown you SBI's balance sheet to understand the components better. In the next video, I'll try to break down a few components like call and short, no, call and notice money, or cash and balances with RBI. I'll try to make a video on Reserve Bank of India to understand what are the functions of RBI. I'll see you in the next video, and I hope you enjoyed and understood the balance sheet of a bank.